Well, March Madness may take a backseat to September Madness as Thursday's print on the PCE and Friday's job numbers will set the stage for the bull market's second season. Meanwhile, fans are waiting with huge anticipation for announcements and invitations to Cybertruck and Highland and AI Day 3 events. The winner seems likely to be those fully invested in Tesla. That's not investment advice. Okay, I'm at the end. I'm going to have another one of those rants, and then just after that, I'll give you the market direction, the pre-market numbers, and what happens to Tesla this week, in my opinion. All right, this is Randy Kirk, and of course, you know all the right things to do. You need to like and subscribe and hit notify because those help the algorithm. Plus, you want to be notified of tomorrow morning's program. Every morning at roughly 7:10, we come out with the after the bell. That's 7:10 California time. And then during the rest of today, sometime tomorrow, I believe I'm going to have Brian Wang on, and we're going to talk about the two other things that happened Friday night with the Elon Musk drive around, the demo, whatever you want to call it. We're going to talk. There was two more issues there that nobody else is talking about because everything else was so top of mind. Headline stuff. You're going to want to see that. All right. And then, of course, Patreon. Thank you so much. Another Patreon member joined, and I need just about 14 more to hit the 225 125 by the end of the month. All right. So governments, who Elon points out are the only monopolies with guns, have a bad habit of creating catch-22s where conflicting regulations make it almost impossible to do the right thing. The US government, heavily depending on Musk companies on so many levels, still seem to be out to jam him whenever they see that they got a chance. So now we have the Justice Department suing SpaceX for discrimination against minority hires? No. Women? Nope. The disabled? No. The Justice Department is seeking, quote, fair consideration and back pay for asylees. Whatever is it? What's an asylee? Oh, that's probably an asylum seeker. I've never heard of asylee ever in my life. Anyway, they're seeking back pay for asylees and refugees who were deterred or denied employment at SpaceX due to alleged discrimination. Now, apparently, Tesla makes it very clear in their notices and everything else that you have to have a green card as a bare minimum, preferably citizenship, but as a bare minimum, have a green card to go to work at Tesla. Well, Tesla then points to regulations stating that they're in a class making weapons, missiles. I'm sorry, Tesla, not Tesla. SpaceX is in a special class because they make the missiles. They're not missiles, of course, but they could be. But anyway, they're in a class of businesses that require employees to have a green card or be citizens. And then they point to NASA having the very same restrictions in hiring that SpaceX has. Now, of course, their lawyers have been telling the Department of Justice this for months, and the Department of Justice has still decided that they're going to go forward with this. It seems to me that this is just nonsense and just driving me nuts. Anyway, probably driving you nuts too. All right. I know that doesn't affect our Tesla stock price, but really. All right. What will our Tesla stock prices be if there's any announcement about the Cybertruck handover, pricing, specs, etc.? Could that happen this week? What could also affect pricing this week could be a Highland reveal or an event notification. So you know how I hammer on the macro being about 50% of the price moves for Tesla. Well, this will be a week where the macro will be moving for sure. Just hard to know which direction. Up through Thursday morning, we can see which way the pros think the PCE and the jobs reports will come down. We can watch the yield on the 10-year bond as a real good indication. If we start going back over 4.32, well, then that means they're expecting a bad print on Thursday or Friday. If it heads down to or under 4.2, well, that means they think good news is predicted. Of course, you will really only know after the publication on Thursday morning. That's the only time they're going to know too, because no matter how good they are, you never know until you get there. All right, here's what's coming up this week on the way to getting there. First of all, we have on August 29th, this would be nothing on Monday, just like zip zero, nothing happening. On Tuesday, which none of these I'll be able to report on until Wednesday, You have the Chase-Shiller Home Price Index for 20 cities. Last month, that was down 1.7 year over year. This particular month, they are expecting it to also be down year over year, but up again for the second month in a row, month over month. I think they're right about that. The exact numbers are probably unimportant. It's the direction that we'll be talking about. That will not affect the PCE print later this week. There will also be the job opening numbers. Last month it was 9.58 million. This month they are expecting that number to drop again below 9.58 million. Probably will. I would expect the job openings number to continue to trend downwards, not because of anything in the economy that would cause that to happen, but because I think companies are no longer padding their numbers as much as they were. And then the third thing on Tuesday, again, that won't be able to be reported until Friday, until Wednesday, is consumer confidence numbers. And those were 117 last month, expected to drop to 116.5. Maybe, I'm not sure. Consumer confidence might come up stronger than these street economists and folks and analysts think it's going to happen. Anyway, then on Wednesday, we get the ADP employment numbers. Those will be able to be reported Wednesday morning by me. It was 324,000 last month, a huge number, completely blew up the market. Market went down. Nobody expected that number. Who knows why we had that huge number? Well, right now, this month, they're expecting back to normal around 170,000. Then on the next thing that'll be reported on Wednesday is the GDP, the revised number. The revision, the street is expecting it not to be revised at all and to stay at 2.4, which was a pretty good number. Then you have the trade balance in goods. No expectation on that one. I would say, yeah, I don't have an expectation either. Retail inventories, I would expect those to be dropping at this point. With manufacturing been so low for so long, I would think that retail inventories would be coming down. Same thing for wholesale inventories, but there is no, the economists have not been polled apparently on those numbers. Then we have pending home sales. That won't be able to be reported until Thursday because it's out so late. But that is, last month it was up 0.3%. This month is expected to be down 0.8%. That would probably be absolutely true because there's no inventory left. The inventory numbers have actually dropped below 100,000 homes nationwide. That is the lowest number ever recorded since numbers have been recorded on that subject matter. Okay, so then we have on Thursday, the big day. Okay, so if I'm a little late Thursday morning, if it's not 7:10 exactly and it gets to be 7:15 or 7:20, don't worry. I'm still going through the numbers and making sure that I'm reporting to you exactly what you want to know, not what you want to hear, what you want to know. So we're going to have initial jobless claims. That'll be out that morning, and we'll have personal income. The street is expecting that to stay even at 0.3%. That's a little higher than the Fed wants it. I think they want it to be 3% year over year. So you would need that to be 0.25 in order to hit this Fed's number. But I don't think they'll be scared by the 0.3 number. Personal spending last month was up 0.5. The street is expecting it to go up 0.7. That would be a strong number. Good for the economy, not so good for what the Fed's looking for. The PCE index. This would be the headline number. They're expecting, no expectation on that one right now. Last month it was 0.2. I would expect that to be no higher than 0.2 and maybe a little down. The core PCE index was also 0.2 last month, and the street is expecting 0.2 again. Now, this is the month over month numbers. I would like to see that core PCE index a little lower than that, but 0.2 I think would be okay with the Fed. That would be a 2.4 annualized. So if it's 2.4 annualized, I think the Fed will be pretty okay with that. And then PCE year over year last month, this is the headline number was 3.0 last month. That is expected. They don't have an expectation on that on the headline number. I'm gonna say that's the one that I would really like to see actually coming down to Truflation's number around 2.5, 2.7, somewhere like that. Just come down a little bit on the year over year. And then the core last month was 4.1. They're expecting that to go up to 4.2. That would be a deal breaker. That would not be good. I don't want that to happen. I'm hoping for 3.9. I think it can hit 3.9. I think it can be lower than 3.9. If it is 3.9 or less, the second leg of the bull is in. If it's 4.1, 4.0, question mark 4.2, that would make the bull market would then be looking for other good information, good news, the next CPI or something, and it might stall it out, might even see some downward action if we come in at 4.2 or higher. Then they have the Chicago Business Barometer. Chicago has been showing the Chicago Fed has really been kind of bullish lately. They're saying that is going to be higher than last month at 44.2 versus 42.8 last month. So that's good for the economy. Then on Friday, we've got U.S. non-farm payrolls. Last month, it was a little bit higher than expected at 187. They're expecting that to drop to 165. I don't have an opinion. Unusual, right? I have no opinion on that. The U.S. unemployment rate, they're saying will drop to 3.5. That has a lot to do with how many people are coming into the employment market, how many people, et cetera. 3.6, 3.5, 3.6 last month, 3.5. They're saying, okay, I'm not sure that's going to change anybody's mind about anything. Now they have their own U.S. hourly wages number, and they're saying they're expecting 0.3. The street is expecting 0.3 compared to 0.4 last month. That would be a very good trend. Love to see that. And then year over year, let's see, that would be 3.6 on an annualized basis, which I think would be fine with the Fed. They'd like it to be 3, but I think they'd be okay at 3.6. And then hourly wages year over year, they're showing that staying at 4.4 for the second month in a row. I don't think so. And I think that would be, again, a not good number. That would be a number that the Fed would not like and the street would not like. So hopefully that is lower. Then we have the manufacturing index coming in. They're actually expecting that to go up a tad. Last month, it was 46.4%. This month, they're expecting to be 46.6%, so a little bit better. And then construction spending was 0.5% up last month. They're expecting the same thing this time. Construction spending, based on what I'm hearing, maybe will be up a little bit better than that 0.5%. We'll see. All right, Trueflation that today is popping up just a little bit again. It's 100% from owned homes. This is not going to show up in the PCE this Thursday or the CPI next month. Rents are still almost at zero year over year. This should start to show up in the PCE and the CPI. So that's where we're going to get some of our help. Now, here's my rant. There are 5 ways that the Fed's high interest rates and their restrictive policies are hurting the economy now and far into the future. I do offer a solution. Number 1, high interest rates reduce inventory in housing markets. Elderly are already preferring to die in place, and now their homes are either paid off or at under 3% interest rates. They aren't going to move, period. That's why we have no inventory. That is raising the average price of homes. Supply demand, economics 101. I took that class. B, Gen X, currently between the ages of 43 and 68, also have 3% interest rates on their homes and are now constrained from moving, even if it's to get a better job, to downsize or upsize, or to raise funds for a business, hurting opportunity, hurting productivity, because they can be more productive if they went into a better job or if they open a new business. C, millennials, now 27 to 42, are scrambling to find homes in low-priced areas or states. They're moving to North Carolina, South Carolina, Tennessee, out into the desert in California. Where's a home that they can afford? And many of them have given up because of these high interest rates right now at over 7% on mortgages. Number 2, high interest rates and loan restrictions are keeping home builders from building the needed 1.5 million home shortfall in the U.S. It's going to take years. Even if they really started jamming, it takes years to get this shortfall pulled together. Well, this could help solve the problem, but it's a long way from being even a slight possibility. Some increases happening right now, but not close to what is needed. They are not building because of their own higher cost. Their cost while they're building the homes, they're paying a high interest rate, carrying charges they're called, while they're building. And then they have the difficulty of selling new homes at full price because of the high mortgages. They're either having to give up something on the price are having to pay down on the mortgage rates. Number three, the Fed just released their own study just now. This is news. The Fed just released a study that shows that innovation is stymied during times of high inflation. They found that, high interest. They found that the effect lasts for years into the future. Folks don't start businesses. Banks can't fund new companies or ideas. Banks can't fund new equipment and automation. And even the venture capitalists sit on the sideline. The market has had zero interest in IPOs. A couple announced this week are the first ones, I think, for months and months and months. So so the high interest rates are stymieing the very thing that we need, which is innovation. And their own report showed that this has an effect years into the future. Number four, high interest rates increase the cost of all products and services. The high interest rate becomes part of the cost of doing business, which must be passed along to the customer if a business is to survive. It also squeezes out some products which are no longer profitable, or that means that you have to take them offshore. Restrictive lending practices make it even worse. Number five, high interest rates encourage savings, but destroy wealth. A, bond values go down. As the rates go up, as the yields go up, the bond values go down. B, stock markets go lower with high interest rates. C, real estate values drop. Yes, I know I just said that the real estate values are going up. They're going up because of lack of supply. But if all else being equal, if interest rates go up, then property values go down. So it destroys wealth. What's the solution? The solution is a small drop in rates and a slow trend down with dovish forecasts about rates. Markets will quickly react to a change in trend with expectations for more of that trend to continue. A gentle easing in restrictive money supply and bank lending would also be a huge help. It can be very, very gradual so that if there is a change in circumstances with regard to inflation, the Fed can pivot. But it needs to happen. It needs to happen soon because it is, as all those things above, all the things I just said, would be helped that it's now hurting. So in the pre-market, we've got the market looking green. Oil is up. It is a little bit above 80 again, but it's still in that range. It's not near the 84. I don't like it being above 80. We hope it's going to go down. So the 10-year is up to 4.251, but that's well below the 4.328 recent high. And the 2-year has broken through 5. Not good at all. So overall, on first blush, not what you want to see in terms of the expectations of the players in the bond market in terms of what they're expecting for Thursday. They're not like throwing in the towel yet, but it's not the direction you want to see. Commodities are starting to become a little bit worrisome, especially with the dollar having such a strong week. I'm going to pay very special attention to commodities this week, do a lot of digging, see what direction. We don't want those commodities to start going back up. Let's see. Okay, Tesla. Assuming no bad news, we will be up for the week on the strength of the full self-driving version 12 demo last Friday, even though Barron's was the only one reporting it. Now, maybe some others will start picking it up because of the Barron story. You know, the news is very weak over the weekend. Friday is not the best time to do a stunt if you want coverage, and maybe Elon did it for the fans, not for the general public, and so he didn't care that it was on a Friday night, which is, of course, the worst time to ever do anything if you wanted to be seen in the paper. Tesla will also be trending up based on FOMO for all the upcoming catalysts and from what I expect to be the second stage of the bull market, because I am expecting CPE to come in, as you know, lower than that 4.2. But if it comes in at 4.2, all bets are off. I'm going to change. Again, Tesla will probably go counter to all of this, but not as fast because it needs the bull market to really make it happen. All right. You may want to look back at this morning's episode where Larry Goldberg and I take a deep dive look at Powell's speech, along with a very, very clear, Larry did a great job with slides and everything else, showing a breakdown of PCE, what each thing means, and how you can look at it Thursday morning in order to see what the Fed is probably thinking about what happens on that PCE report. There's a card right there for that one. And then, of course, just tomorrow morning, you want to be there for the opening bell, and you want to, or at what I call after the bell. And then later in the day, I'm expecting to have Brian Wang on. You definitely want to see that one. So that's all I got for you right now, except that you should like, you should subscribe, you should hit notify so you're notified of all those things. And you should buy the book, buy the book. Or if you want the audio book for free, then you go down below, find the link to Patreon and join Patreon. You get one free one with a $5 membership and two free ones if you get a $10 membership. So I'm exhausted. See you in the morning. It's been great talking to you.